This is Akhil from QuantInsti India. So we welcome all the participants who have registered and they are currently attending the webinar. And I'd just like to introduce Dr. Yves Hilpisch, who would be taking the webinar. So he would be informing broadly about Python, how it is being used, into automated trading. And of course you can there will be a lot of informative stuffs that Dr. Yves Hilpisch will share. We request all to have we hope that you will get the best out of the webinar, and whatever questions you have, you feel free to ask to Dr. Yves, and through a chat box, and Dr. Yves will reply you on that. So we would again welcome you all, and I can just ask Dr. Yves Hilpisch to take the lecture from here. Dr. Yves, you can take it further from now.
Okay, thank you very much, and thanks for having me.
Yeah.
My name is Yves. I'm founder managing partner of the Python Quants. I will speak a little bit more about myself in a minute. Today's topic is, as mentioned already, automated trading with Python. Thanks again for QuantInsti for having me and hosting this webinar. Let me jump right away into the presentation. Later on we will get interactive as well. I will show stuff real time, but for the moment I will rely on a few slides to introduce the different topics. First, as mentioned before, a little bit more background about myself. Founder and managing partner of the Python Quants group. We focus on Python and other open source technologies which are applied in the financial industry. Our focus mainly lies on the computational finance side and financial data science, not as much on the unstructured data side. What we work with usually is structured data, and I guess this is where our strength lies. We have, for example, also implemented and built up a platform which is called Data Park, which allows data science in the browser. I will later on use the platform, which is also called Quant Platform, and will show interactive examples of what we're going to do today. Some of you might know me from the O'Reilly book, Python for Finance, or the big one. It came out in 2014, and it introduces Python for the use of finance, and I guess many people have read it already, and I'm really happy about the success of this book. My other book is called Derivatives Analytics with Python. It came out last year with Wiley. It's much more on the quant side than on the Python side. It has lots of Python in it, but it doesn't explain it, so you need the red book in order to understand what's going on here. But for those in derivatives analytics and doing market-based valuations, I guess it's quite a good book if you are using Python to this end, actually. My new book will come out this year. I just finished the first draft. It's called Listed Volatility and Variance Derivative, and it's obviously also Python-based, and it guides you through all the things that you need to know when it comes to these modern, so to say, second-generation derivatives, which have become quite popular, like the VSTOXX index and derivatives based on it, or the VIX index, and as well, obviously, the derivatives based on this established index, actually. Now, for those who are curious, I have listed here a few links, maybe too many that you follow them all right away. But you might start at our company website. This might be the only link that you might want to write down. You find links to all the other things that you see here on this particular site, and it's simply tpq.io, and you find all the background information, and usually also some current announcement in this regard. Another topic that I want to mention here is that we are starting to build a global network of Python quants and companies from the industry using Python. We call it TPQ Opportunities. This is kind of an outgrowth of many email exchanges and calls that I had recently, because more and more people are approaching me and asking me how to best get into Python for quant finance, and also many companies approach me and ask me, like startup companies, for example, located in London or New York, if I would know some good people who could join a team who want to do Python for quant finance. So what we will start right away is this TPQ Opportunities. If you're interested getting into the space, or if you are from a company and have a need for Python people who have a background in finance, please drop us an email on team+ops@tpq.io, and we will try our best to have the patches in our universe actually. Well, that's already it for myself. That is now go right away into the topic of today, automated trading. The topics we are going to cover today are actually all based on the Yuanda.com trading platform. What we will see today is how to download historical data from this platform, how to code and backtest a trading strategy, and how to work with streaming data. So if you want to do automated algorithmic trading, you need to work with streaming data, and this is usually a little bit more involved than work with historical static data. We will see how this works, and we'll end up with indeed a demo of how to automate the trading strategy, and so to say how to build a simple Python robot which makes your trades. I tried to keep all the steps as simple as possible, so I will focus more or less on the steps and the interconnections and what it means to implement these single steps. With regard to contents, again, I kept it as simple as possible. We will see that we're only testing a very simple trading strategy. We will also implement a very, very simple trading strategy. So this is all simple, but I guess you will all get a good feeling of what it means to work with Python in this area of automated trading. Data retrieval. Without data, no backtesting. Without backtesting, obviously, or usually at least, no sensible trading strategies. Let us start with a little bit of Python. So it's not necessary that you follow all the details here, but if you're already in Python, you know that you hardly come along without importing additional libraries. And what I'm doing here is import some of the standard libraries like NumPy and Pandas, but also some special ones here to interact with the Yuanda platform, which is called here in this case YuandaPy. It's a nice wrapper around the data API for Yuanda, and also a little bit more like plotting inline here in the Jupyter Notebook and so forth. For those of you, I guess, who are in Python already and using Jupyter Notebook, this might all be very, very standard. The second thing is that we need Yuanda credentials. I have stored my credentials in a pickled file on disk. So what this code does is nothing special. The only thing that happens here is that I read in my account ID and the token that I need to interact with the platform. So to say, all the credentials that I need to log into the platform to retrieve, for example, data, which will be one of our next steps that I will show. Once I have my credentials, I can then go on and connect to Yuanda, and here in this case I instantiate a connection object, an API object as it's called here. And what I'm doing here is in a practice account. These practice accounts are free and fully functional. That's one of the reasons why I like to use Yuanda for demo purposes. So when we later see the trading strategy in action, yeah, there's not a big deal actually when we lose some money with the trading strategy, because it's all, so to say, paper money, and we won't lose real money. But maybe we'll see that the strategy performs well. Who knows? So, but again, be assured it's only a practice account, and the money that we will trade will be paper money only, actually. So with this object, which we have called Yuanda, actually, we can, for example, this is only one of a multitude of options that you have to work with such an API object. We can retrieve all the instruments that are tradable on the platform. So a little bit of background with regard to Yuanda is kind of a contract for difference broker. So in principle, what you can do on the platform is to trade, to go long or short certain instruments. For example, in this long list, you might find something that we will do later on. It's an instrument that mimics the German DAX index. I'm German, so I will use this as an example. But you also see here, for example, the SPX 500 in US dollar denominated. This mimics the S&P 500 index from the US. But you also find currency pairs, obviously, that you can trade on, as well as commodities, for example, like gold or silver. So in a certain sense, what you can do on this platform with a little bit more than 100 instruments, you can do something like global macro trading or investing. It's not the whole universe, but I think you can implement a few strategies quite well on this platform. But again, later on we will focus on a single instrument only. All the stuff that we will see obviously applies to other instruments as well. Let us start with data retrieval. Here in this case, I only retrieve data for 2 days. You see here, I picked the 3rd of February this year as a starting point and the 4th of February this year as the end point, actually. So with these 2 dates defined, we need 2 additional parameters. The one is about the instrument for which we want to receive historical data. Here in this case, I mentioned it before, I will work with the German DAX index, and at this time here in Europe, in Germany, it's a little bit later now, at 1:30 p.m. We still have trading hours open, so obviously I can show this later on in real time because we will get data indeed in real time fed by the API. And the granularity here for this very simple example, I put to capital D, which means that we will retrieve daily data with this call. But let us have a look what the API gives us back. So what we get back here is a JSON object. You see here in the candles part that we have actually 2 observations actually for 2 days. You see for the 2nd of February and 3rd of February we have, for example, the open ask, the open bid, you have the close ask, the close bid, and so forth. So this is what we get back. When we want to work in Python with that, this JSON formatted data has to be parsed, but this is very simple. We have libraries which support us in doing that. When we want to do a backtest, we might need a little bit more data. So the assumption that we go with 2 daily observations only is a little bit, or the data set is a little bit too small when it comes to backtesting. No meaningful results can be expected from such a small data set. Let us generate a data set which is a little bit larger. Actually, we will shift in a second to 1-minute bars from the daily granularity. And we will retrieve data starting from the 10th of November last year up until the 13th of November last year. So for a couple of days, we retrieve data on a granularity level of 1 minute. So we will end up with a data set of 1-minute bars for our German DAX index instrument here. Before we retrieve the data, I open here an HTF Store, which allows me to easily, conveniently, and also quickly store data in the form of pandas data frame objects on disk. Actually, for what I want to demo here, this is not necessary, but I just want to illustrate how it works and how simple it works. Because usually when you retrieve data, you don't want to retrieve it again and again. You might retrieve it once, store it on disk, and then have rather quick access to what you have stored on disk. Actually. So the major step here, what we do is to retrieve the data chunk-wise. So we again define here the instrument in the first line of code. We then instantiate a data frame object, which is empty, nothing defined, just constructor is called here. And we have kind of a print interaction here that we know that it all started. And then we have a loop here, a for loop, which loops over the dates that we have defined before. You remember we have selected a few dates from last year's November, actually. What we do here is just some simple string replacement operation that the API understands what we are looking for, actually. And in this try part, you find the major operation. So for a certain given start date and end date, we retrieve for our instrument the history, and we also do a time zone alignment here to Europe Berlin, which is my time zone actually, and the granularity, I mentioned it before, is here set to 1 minute. So we get many observations even for a single trading day only. And since we are doing it chunk-wise and not as a whole, so to say, we have to append the data to our data frame object. So this data object is here in this case appended, or the data that is stored in this object, this JSON object, is stored to our data frame object and appended to our original one. So you see, it doesn't take that long. The execution of this data retrieval took only 1.9 seconds. So we are working with rather granular data, but the data set still is actually quite small. Here in this step, you see that we again do a time zone conversion here, but the major thing here is that we write with this line of code, we write the data that we retrieved from the online API to our database object, to our HTF store on this. This is a binary storage format, and you can expect that the storage operation here happens almost at the speed of the hardware that you have built in your machine actually. So now we have the data on this, and we can work with it. To work with it means, for example, that we can illustrate it. So here you see we've mainly retrieved data for 3 days actually. And you see in between there are quiet periods. Obviously this is where the markets are closed, but in between we have rather granular data. Again, I want to mention it, it's on the minute level, which might not be as obvious here from this chart actually, but if we have a closer look and only a certain subset from the data that we retrieved, you see now better that we are here indeed on a minute bar level, and this is only for 100 data points out of a few thousand that we have retrieved before. So this is kind of a zoom in operation, and I'm just visualizing here a very small subset of the whole data that we have retrieved. That was already the very first but important step. Again, without data, there is no backtesting. Without backtesting, we cannot be sure that our strategy makes some sense at all. I mean, there is no guarantee that if a backtest of a strategy is positive with a good result, that this will also be the case in the future. But this is something that you do at least in order to get some kind of understanding how the trading strategy behaves. But let us now come to the backtesting of a simple trading strategy itself. When we want to judge the performance of a certain strategy, we need to look at the returns of the strategy. And what we do here as a very first step is that we calculate the log return as a basis for our later performance judgment. So here in this case, I'm adding to my already existing data frame object, which contains all the data that we retrieved from the Wonder API. I add a new column, which I call returns, and I calculate, given the close ask values, the log returns over the whole period that I've covered in my data set. This happens in a completely vectorized fashion that we're using here in NumPy universal function, and we are dividing the one column by the very same one column, but now shifted by one index day. So we have a very compact syntax for many, many operations that happen here under the hood, and this is typically what you call then a vectorized operation. As in mathematics, when you have, for example, a scalar product with a scalar which multiplies a vector of maybe 1,000 values, for example. This is what happens here in a very compact fashion. And this is also not only compact syntax-wise, but this is also very performant even for quite large data sets. But again, this is only the basis. This has nothing to do yet with our trading strategy, but we will need it later on to judge how our simple trading strategy might perform. So let us come to the basic ingredients of our trading strategy. What I want to show here, and again, my whole talk is not about kind of devising the correct trading strategy, but I'm using here an example which has been quite popular over years and decades, which has been not only applied in practice, but which is also the topic and at the center of certain research papers and so forth. It's a strategy which generates signal based on two different trends, a shorter trend and a longer trend. And to have something which we can show quickly enough later on, I have chosen two very short periods of time, if you like. The one is a simple rolling mean over 5 observations working with minute bars, means that we take here the simple rolling mean over 5 minutes. And the second case is the simple rolling mean over 15 minutes, a quarter of an hour actually. And the basic idea, you might know it, is if the shorter trend crosses the longer trend from below, then this might be a signal that the market will trend upwards and the other way around. So if the shorter trend crosses the longer one from above, this might be a signal that the market will go down, at least for a certain period of time, and this is what we want to mimic. But we will focus on a long-only strategy only in order to keep the code that we need as simple as possible. So now that we have added that stuff to our data frame, we can easily visualize that. So you now see, or might not see completely what's going on, but at least you get an idea here that we have the blue line, which is the same as before. This is our basic data that we use. We have the green line, which now represents our 5-minute moving average, and we have the red one, which presents our longer-term trend. So again, they almost overlap over the complete picture. So in the next chart, I again zoom in to only 100 observational points. They're actually the same points that I've shown before with the blue line only. And now you see what I mentioned before. So we have here a constellation, for example, picking out the green one, the shorter trend. At this point, it crosses the longer one from below. What you would think is that this signal is kind of an uptrending market. And indeed, what we observe here for this particular case is that the blue line, our real market, our spot price, actually moves upwards. And the other way around, the same thing. We might look at the end here. You have the green line crossing the red one from above. And this might be a signal for the case that the market is going down. And indeed, what we observe here is that the blue line goes down and we have a spot price indeed declining here. So this is what we want to implement, this idea. If this performs in practice, we don't know. And if we don't know, what we do usually then is a backtest. And this is what we want to do here in this part. But I first wanted to show you the basic data that we are working with and the basic idea behind this simple trading strategy. Again, this is no advice of implementing that. We don't give any kind of investment advice. Our focus today is here only to have something which we can use to illustrate how you can implement that this whole process technically. But again, please do not do it on your own, and please do not complain later on if you might be losing money with that. But now, in the next step that we have understood what a trading strategy does, we can use Python again to indeed generate our signals. And what we want to do here is implement, as I mentioned before, a long-only strategy. So we don't want to bet for periods where we think, given our signal, that the market will go down. We only want to participate here in a case where we think, given our signal, that the market might go up later on. So we have only two basic positions, and I'm choosing here the one as the representation of being invested in the market. One means one long, you can interpret it that way, and 0 is not invested otherwise. You could think of, if you're invested, for example, in the DAX index, if you sell everything that you've invested in that, you might park your money in cash in the bank account, and this would mean here in our case, not invested actually. And the Python code that we use here, and this is the central thing, is again in vectorized fashion, that we now use our two trends that we have calculated before and stored in our df data frame object. And in principle, what this says is whenever the short-term trend is higher than the long-term trend, then we go long, otherwise we don't want to be invested. So this is what this whole thing does, and it does it again for our whole data set in a single line of code. You notice here is no for loop included or whatsoever. It's just a single line of code, and we can implement all that in vectorized fashion. If the condition holds, go long, which means, again, in our symbolic and our mathematical representation here, being +1 the market. In the next step, and now the point has come where we use our returns that we have calculated before, we can now calculate the performance of our trading strategy. What we do is kind of taking the position that we have entered, one trading point, 1 minute, or 1 day, depending on what data you are working with from before, and multiply that with the current realized return. So if you think, and this might be a little bit more simple to shift for the moment to a daily thinking, if you have invested yesterday in the market, for example, and you are long the market, and then you wait for one day and you see how the returns materialize for this one day, and then you multiply your position from the last day, be it long the market or being not invested in the market, by the return. So whatever return we have, we either multiply it by 1, then we get the market return, or in our case, if we are not invested, we multiply it by 0, so we get the 0 return, no matter what the market does. So we might be missing out on a market return, or we might be lucky if the market goes down that we haven't been invested long into the market. So previous position combined with the current return, this is the calculation here. And again, we calculated the returns before in a vectorized fashion, and in particular we took the log returns, because later on when I will sum up the log returns, I will apply the exponential function to get to our exponential returns for that. That's the very reason why I'm using it the way I'm using it here. So let us have a look. So in our case here, you see the green line is our strategy, our simple trading strategy, and the blue one is a return line from the market only. So the blue one would mean, for example, that at the beginning of our data set, of our observational period, you would invest into the market and then would do nothing. You wouldn't trade in, you wouldn't trade out, you just would hold the position. And what you would see here is that you indeed would lose money for these particular days, actually. What we see here is that our trading strategy performs a little bit better. It's not excellent, but given the negative performance of the market strategy, we have a positive return here. But there is no guarantee actually that this is the case for every period. If you have a look at the very beginning here, for example, you see that we indeed are losing money. So again, no guarantee that the strategy performs well, depending on the time horizon where you look at. And I want to again zoom in. You see here again the very same subset of the data that we have seen already twice. That you see here that our strategy performs actually worse over this particular period. So again, there's no guarantee, and this should be as a word of caution that this might not be a very good strategy to implement. But again, let me switch back. We see here at least over the period that I've picked randomly, we see that the strategy performs well. So we might be inclined in saying, well, if this works over the period that where I've implemented the back test, actually I could try out this strategy in the market because I have positive results. So why not? I wanna risk my money, and this seems to be a valid strategy, at least given our back test results. What I haven't included here in my example is, for example, what you should do at least, that you should test your strategy, which might be optimized in a certain sense, that you, for example, choose 2 different moving average. You would then test it out of sample. So what we have here is obviously maybe an in-sample bias that this might be only due to luck that we earn the money here. But again, this is not my focus, how to do it correctly, so to say. I just want to touch upon the certain single steps that are typically involved in such an effort. But again, you should have a much closer look if you are about to decide whether to implement such a strategy or not. Because again, here you see for certain periods of time you might see a huge underperformance of such a strategy. What I also calculated here is the number of trades. So you see it might also be quite costly to implement this strategy. We have over the rather short period that we cover here, we have 182 trades that are happening here. So yeah, rather, I wouldn't say high frequency trading, but it's also not kind of a passive strategy. You see the strategy leads to very active trading. I think this is the right way to put it, actually. Another statistic of interest might be worth noting here. It's the standard deviation of returns. I explicitly didn't write about the volatility because volatility measures are usually annualized one, or you have kind of a certain time frame you refer to. I just calculated here the standard deviation of returns, and we must bear in mind that we are working here with minute bars. So we are speaking about volatilities for minute bar returns. But what we see here actually is that the standard deviation for our market investment strategy is quite a bit higher than for the strategy and that we devised given our trend-based investment signaling. This is also true, for example, because we are not invested over longer periods of time, where there's no contribution to our volatility. But again, it's kind of a nice feature that we have lower standard returns, standard deviations of returns here for our strategy. So this is the point where we now have data retrieved from the Rwanda API. And we have found a strategy which, at least over a certain period of time, which we picked quite randomly from last year's data, performed quite well. And now you might say, well, I've tested this for 2 weeks straight, I've worked hard, and I'm really sure that this is kind of a good trading strategy that I want to implement. The next step is then to start working on the implementation. And a very important step, and this is the reason why I've put it in here as kind of very high level, as one of the main agenda points, is to work with streaming data. Because if you want to implement such a trading strategy in automated fashion, you must be able to process streaming data and to, in the end, base your decisions. Your trading robot, so to say, must be able to digest the data real time and to come up with trading decisions in real time. Otherwise, all the stuff that we have been doing before would work out as we expect. So implementation is important, and to work with streaming data is obviously kind of one of the major pillars that we need to care about. So let us start with some basic preparations for this part. Actually, we have first, like always, I mentioned before, some imports, and I now want to use the Plotly API to generate nice plots. Actually, I will in a second shift to an interactive demonstration, because what now comes you should see live and in real time, because what I can only show with my slides here are static snapshots, and you won't even notice that in the background there has been some processing of a real-time data feed. But again, we need here a few imports, and in addition to our Rwanda login, we now log in to the Plotly server, which might not be necessary anymore because they now provide local installation as well. But I still like to work with the server-based infrastructure, and this is what I'm doing here. But give me a second before I now shift to the interaction. I might have a look whether we have a few questions actually. But as far as I can see, there's someone saying that there's a little bit of echo. I hope that this problem is solved actually. But there are, so far at least, as far as I can see, there are no questions with regard to any content type here in this case. So let me now quickly jump into my interactive illustration. We'll enlarge that as well. So I'm now working on the Quant platform, where I have the very same Jupyter notebook, which you have seen part of as the slide presentation. And I will now quickly go through the single parts. First, what is it there? Let me simply restart the code and reset everything. So we have a clean notebook now, which I can use and start working with it. Just quickly doing the imports here for the stuff that I need later on. So you might note that this is the content that I've presented before. But I want to get to the streaming part here, which I now start with the imports that you have seen on the last slide I have shown. So what I'm doing here in this part, I hope everything is large enough for you to read. I'm even enlarging it a little bit more so you get a better grasp of what is going on. What I'm using here is kind of a fake API that we have implemented, which delivers random data, but in the very same format as the Wonder API. It delivers the data in real time. So we have here kind of nice sandbox that we can work with. And you see this runs on our Quant platform under this port. And we can, for example, if we start such a request and request data from this real-time API, you see again that we get back a JSON object. In this case now for the euro-US dollar currency pair. And again, this is all random number. This is fixed to a certain level, and it's only kind of random numbers that are added to the fixed level. So just see this as kind of a template for the data structure and not the data itself. But again, we can work with it because we can now, after we've seen how to retrieve a single data point, we can now collect a few data objects actually. This is rather quick. We have collected 100 data objects, and you see all the data is now collected in a data frame object. And I'm showing here the last 5 observations, and you see this is given our time zone here in Europe. This is rather current from the very second I've done this right now. So we have no data that we can visualize easily. So enlarge that a bit. And you see here the interactive visualization. And you see this is a very random structure actually. We can, for example, zoom in and work with it. But again, this is just a simple API which generates random data which we can work with here to illustrate what we're going to do. This was kind of not real time, if you like, or streaming like. What we've done is simply via a loop, we have collected certain data points and afterwards have visualized the complete data set in a single step, actually. So this is not what we understand when we say we're working with streaming data, but we can do this with a little bit of more effort, additional effort, which is involved. And to this end, we need to instantiate a few more objects to work with the Plotly API. In this case, you see I need additional credentials here for my streaming, with my streaming ID actually, and I have to instantiate a stream object, which I later use to put my stream data into, which then gets visualized. So a little bit of code is involved here, and there is a little bit more that we need to take care of because we want to plot this as a scatter object in the end, and this is something we have to instantiate here as well. And you see I have put the mode parameter here to lines plus markers. So in the end we will see our points, our single observational points, but they will be connected by lines. So the next step is to generate the object itself. This happens here, and now the object is in existence, but we can't see it, so I need to embed it here into my Jupyter notebook. So, but you see this is an empty streaming plot, so nothing streams yet, but we have opened our stream object actually, and we can now put data into this pipeline if you like, and this is what happens with the code down here. This is actually again based on a for loop, similar to the one that we have seen before. And what we do here is we collect the data from our fake API, and we parse that, because it's JSON based, and we write the data in a certain format to our streaming object. And we wait a little bit before we go to the next iteration of the loop. So let us try if this works. So now you see it already working in real time. So point by point gets retrieved from the API, and via our streaming object, streaming pipeline, where we write the data to, as soon as we've retrieved it, you see that this plot gets updated in real time. So when following the markets, for example, you would interact to the streaming API of Wonder in this case, and you could in real time visualize the current situation in the market as the data gets updated via the API, actually. So a very simple example how to work with streaming data and how to visualize that. In our next step, we will now work with the, so to say, real stream data from the Rwanda API, but we won't visualize it. We will now come to our final part here, which is called automated trading, and as the title suggests. What we will do here, we will use the data that we retrieve in real time, our streaming data, and we will then trade based on the data that we retrieve and generate signals as we go and go along the market or disinvest or keep our money in cash. And this is what we're going to do actually. So before we can start trading, we need basically two functions. The first function that you see here is to place a buy order. And we call it simply buy. And the only parameter that we pass into this function is the number of units. So trading on the platform always takes place based on units, and you can also define the leverage that you want to trade on the platform, and this in the end together defines what or how much capital is at risk when the market moves up or down actually. So in this case you see in the end there's only one call to the Rwanda object actually here with a few additional parameters that are needed. Here you see we want to buy here in the end, and the type is a market order. So it's a very simple, or the most simple thing that you can do. We buy simply the number of units that we provide the function with, and that's mainly it. And the second one, it's more or less the mirrored function if you like. This is to sell in the same fashion. Here you see the side parameter set to sell. Again, it's a market type, and we create such an order given the number of units that we have in there. But before I can use this function, I need to instantiate my Rwanda object. So give me a little second to get back in my code here, because I restarted the object. So here these two. So now I'm logged in, so to say. I have now a Rwanda API connection object. This is simply called here in my code Rwanda, and this is what I can use later on to do the trading. So we go to the automated trading part. Now I can safely execute these two cells, and I have now defined my buy and sell function. And now we come to the core of this whole thing. So I try to put it all on the screen so you can see it. This is the basic class that we use to trade. It's called Trend Trader because our trading strategy is based on trends. And I will quickly step through the single parts of this class, which might look big, but in the end, if you have a closer look, it's only very straightforward code that is applied here. This class inherits from the streamer class of Rwanda, of the Rwanda wrapper around the API, and we define a few custom attributes here. For example, we define an empty data frame object. The number of ticks is 0 in the beginning. We want to trade 100 units per trade. So if you go along, we buy 100 units of our instrument. In our case, this will be the German market again. If we sell, then again, we will sell exactly these 100 units in order to be market neutral. We can define here the first trend and the second trend as parameters. This is what we pass into the instantiation here. And in the beginning, when we start trading, we are not invested. We need to keep track of whether we are invested or not, because the function will then decide whether there's a signal to sell or not, actually. So in this part, I only want to highlight what is important here. So the method onSuccess gets called whenever there is new data from the streaming API. So think of the streaming data as a very, or taking place on a heterogeneous time grid, in the sense that it's not that what we have seen before, that there is kind of a homogeneous regular time grid where we get data. It might be that we get 10 observations per second, and then there might be a second where we don't get any observation at all. So, but here in this case, we don't really care, because whenever there is new data delivered by the streaming API, this onSuccess method gets called. And what happens here is that we just count the number of ticks. So whenever this function is called, we increase self.ticks by 1. So if it's called 10 times, we know that 10 ticks have been collected by this function. So here in this case, we have data available. And with data, I mean this data object, actually. And we can work with this object, which contains, for every call, the then current data just retrieved from the streaming API. We append the data to the data frame that we have instantiated before that. We then convert the index data again to our European time zone, Central European time zone, and update the index. Given our new data frame, this is the next step actually. Here we calculate two trends, T1 and T2 called, but again we can here define which kind of time window we are looking for. So in the end, that we see that something is happening here, I will base all this on a tick databases, and I will take very short trends here, like 5 ticks and 15 ticks, that we would see something's happening. This might not be sensible at all. This might lose money at a very rapid pace. But again, my major focus here is to illustrate how it works. And in order to see something meaningful and not to wait for like half an hour until something happens, I have chosen this way, and I will show it based on tick data with very short trends actually. And here, the decision is made whether to go along the market or to get neutral again. So whenever the short-term index is above the long-term one, and if we are not invested, then we buy the number of units that we have defined above. And we set the self not invested flag to true. Otherwise, if we are invested, then we're going to sell. That's mainly it. Whenever the short-term trend is above the long-term trend and we are not invested, then we go long. If the other condition holds, which means that the short-term trend is below or equal to the long-term trend, and we are invested in the market, then we sell. So this is exactly the strategy that we have backtested, but we will now, I mentioned before, we will now shift to a much shorter time frame. During the backtest, we work with 1 minute bars, and here in this case, I will work with tick data, again, just to illustrate that indeed something is happening here in real time. So the last thing in this class is the on-error method. And in this case, whenever an error happens, for example, the connection is passed to the Yonder API, then this will simply disconnect. But this is just something to catch any kind of error that might happen, and then the code class by itself disconnects from the Yonder API. Streaming then stops actually. So we can execute the cell in order to have the class in our namespace available. And the very last thing that I'm going to show you right now is what happens when we execute that. So here in this case, you see, I'm scrolling this up, that I'm instantiating a trend trader object here in this case, and I set the short-term trend to 5 observation points and the long-term trend T2 to 15 observation points. The rest is more or less only organizational, saying that we're working in a practice environment, and you have to provide an access token in order to get access. And with this method call, I can start the trading given the account information that I provide and also the instrument information that I provide. And the last step, whenever this finishes, this will actually never happen here in this case because I don't have any kind of automatic stop point. I even skipped that in the class. I need to manually stop the trading. Otherwise, the robot would trade whenever there is kind of a new information. But let us see if it works. Actually, our instrument is not yet defined. I can I can simply define my instrument here. This was defined previously in the other part. So now have our instrument defined, and you see now the class running, and you see tick by tick we get a printout. And see the first 4 have been rather quick, and I will later on show you. Now it is collecting the book, and I'm just quickly skipping to now the view to FX trade, and you see already here that we have a long position. So my program has already entered the market, and now you have seen that it has exited the market. Now we are again long, and this is what I wanted to see, that we get lots of activity. I can also go here to the activity chart part here in my overview, and you see exactly here. Let me quickly switch to Germany in 5 seconds, that we see live action here in the market. Now you see here that an order has been placed going long the market, and now we are invested long the market, and obviously we are losing money. We have already lost 200 euro by entering this trade, but still the trend trader says we stay invested in the market, and now you see the sell order has been placed and we are market neutral again. This is the view actually in real time. You see this is in real time from the where you run the FX trade GUI, actually, which is web-based. And if I'm switching back here, now you see the output. So here you see the tick data that we retrieved, and here the first buy has taken place. And after 4 ticks only, we have already the selling of 100 units, and so you see what is going on. And since I have implemented the strategy in a way that we compare the average of 5 ticks with the average of 15 ticks, actually we have here selling and buying sometimes even after 1 additional tick only. And here you see a row where we have a few more, but you see the trader is working in automated fashion. And again, the point wasn't here to illustrate how to make money, but rather how to implement such an automated trading strategy without any kind of risk management and so forth. But again, if we go back here, you see the Python program is running, and on the here on the overview of the Wonder account for myself, you see here in real time the orders placed, and you see how the positions are entered and exited in indeed real-time fashion.
Well, algorithmic trading requires you to merge 2 traditionally disjoint set of skills. One is finance, another is technology. So you need to merge skills in finance and technology to be able to do algorithmic trading. So you need to understand the markets, you need to understand big data statistics to be able to design your strategies. But once you have designed the strategies, you need to also understand technology to be able to automate your strategies. So therefore, that is where the QuantInsti's education programs come into place. So we train people about the entire gamut of operations and skills required to be able to be a successful algorithmic trader.